warnings, predictions and concerns about the state of our economy coming thick and fast, pressure on and questions being raised over the performance of the Reserve Bank Governor, and it would seem we are shaping up for recession. Well, one guy who keeps a very weather eye on such things and advises businesses and others about how to weather economic vagaries and storms is Cameron Bagrie, the founder and principal of Bagrie Economics. And Cam joins us on the line, I think, from the home office now. Cam, how are you? Good morning to you.
Good morning. It's actually not the home office. It's over the hill a little bit in Martinborough.
Oh, okay. You're being a Wellingtonian, going over to Martinborough for the fine wine and food. Cam, firstly, just in basic terms, we are heading towards a real bumpy patch, right?
Yeah, and there's no sort of sugarcoating what's going on. We're either going to have what's called a soft landing or a hard landing. And you got to look back and have a look at the past sort of couple of years. Well, what we've seen is some exceptional economic times. When you look at property prices up 40% in a couple of years, you see unemployment get down to 3.2%. New Zealand navigated COVID really well. But what drove it? It's what's called sugar candy economics. And sugar candy, you can pump yourself up on it temporarily, but it doesn't tend to be very good for your long-term health. Yeah, so what we're into now is called a little bit of the paying the piper stage of the economic cycle. Is what are we now starting to see? Things are starting to pop in an unfriendly fashion. Now, the big bogey variable out there at the moment is inflation. And inflation's been driven by offshore, but it's been driven by the domestic economy at the moment that has literally been overheating. So how do you get inflation down? Well, the Reserve Bank wields the big anti-inflationary stick in the form of the official cash rate, and it looks like it's going to be going up a lot further from here. That's bad for growth. That's bad for asset prices. Welcome to paying the piper.
When we talk about pushing up the interest rates, how does that, in layman's terms, control inflation?
Well, it takes money directly out of people's pockets. If you've got a mortgage, etc., that tends to reduce spending you can put on other parts of the New Zealand economy. One of the big mechanisms that impacts is the construction cycle and the housing price cycle. Interest rates, if they move down, are really good for asset prices. If asset price moves up, you feel wealthy, you tend to spend a little bit more money, and the construction sector tends to rip along at a pretty fast pace. Of course, it works on the other side of the coin as well. If you put interest rates up, it doesn't just take money directly out of your pockets. We've seen house prices that have moved back 6% from their peak from November. If you don't want to put that in a dollar value in regard to what it's been, New Zealanders have taken about $100 billion hit to their net wealth in the last 6 months.
$100 billion?
That's a big number, but you've got to realise that over the preceding 2 years, they made $600 billion.
Yeah, but that's on paper, isn't it? Really, largely.
So there's what's called the wealth effect. And the wealth effect is sort of what is people's inclination to spend out of wealth. And it's typically 3 to 5 cents in every dollar of wealth created. So let's say we made $600 billion. Well, most people don't view that as money they can spend, but some people do. So you multiply $600 billion by 3 to 5 cents, well, you've got an economic sugar hit to your retail sector of 15 to 25 billion. It's still a massive number across a $350 billion economy. But of course, it works in reverse. If you're down 100 billion, well, you probably take out $3 to $5 billion worth of retail spending. And those are some of the key mechanisms by which monetary policy actually work to basically tame growth. But it's not just about taming growth. You got to see the real life consequences here in regard to the unemployment rate needs to move up, and no one wants to acknowledge it. But the unemployment rate needs to be close to 4.5% as opposed to 3.2% to start to see wage growth moderate. At the moment, wages are moving up fast, and that's a good economic story if we're getting productivity growth. The problem is that we're not. So it's adding to what's called unit labour costs. It's making life tougher for those small to medium-sized enterprises. Their wage bill goes up. What are they going to do? Odds are they're going to push up the prices of the stuff that they're selling on the other side.
Cam, I want to come back to this issue of mortgage rates and the interest rates going up. Does that mean that a certain number of New Zealanders this year who have, I know, scraped and saved or said, oh, property's a sure thing, I'll get in there, are we going to have New Zealanders who won't be able to pay the mortgage or go into negative equity in their properties?
Oh, without a doubt. And that's the unfortunate consequences of when the economic cycle flips on the other side. I guess from my perspective, you're not setting policy here for the few. You're setting policy for what's going on across the broader economy. What we know at the moment, we've got a big inflation problem. So the Reserve Bank is once again wielding the stick. That is going to see some people get into economic difficulty. Now, if that becomes a lot of people getting into economic difficulty, well, I don't think the Reserve Bank will be lifting interest rates to 4%.
Yeah, and that's the other point I asked, because surely the institutions most at risk here as institutions rather than individuals are the banks who have loaned all that money on those houses.
Yeah, and if you look at the non-performing loans for the likes of the housing market across banks at the moment, non-performing loans in the housing arena for banks is 0.2% of total loans. So it's a drop in the bucket. Yeah, it's a really world-class figure in regard to how well they manage those books. And what tends to take place is if people do get into difficulty, there are mechanisms that banks can help people with, because no one wants to take it down to that sort of last Charlie sort of stage where it's a mortgagee sale. That's not in the interest of the borrower, and it's certainly not in the interest of the bank. So every alternative will be exhausted before we go down that route. Yeah, but I guess the more interesting part of the market, Sean, is probably people that have been involved in speculative property development. The more high risk sort of game.
You're saying speculative property investment?
Yeah, well, all these people that have been, for a lot of people, property's been a real easy win for the past few years because the property market's gone up. Why? Because interest rates have gone down. Well, we're now in a different stage of the cycle. Interest rates are moving up. Construction costs have gone through the roof. So if you're sitting on a property development at the moment, odds are, your material costs have absolutely ballooned. Your pre-sales are not what they were on the next project. So we always see this in every cycle. A whole lot of construction companies go bust. And construction companies do really well on the up. They tend to be pretty vulnerable on the other side. Yeah,
they do, and there'll be plenty of stories around about that at the moment. So, Cameron, what does that speculative money, presuming there's any left in the economy, do when we're on this side of the economic cycle? Where does that money go, and where would it be smart for it to go?
Well, look, I'm not a financial advisor.
No, and I love it. We get the disclaimer, nor me.
Yeah, but there's an old adage that, I got taught around the global financial crisis. Look, when you eat like an elephant, don't expect to pass wind like a mouse. When asset prices go up, expect to give a little bit back on the other side. And we've seen, look, it doesn't matter whether you look at housing or you look at equities. I mean, equities have been down since the start of the year. But if you ever look at the last week and a half, equities have actually had a really good week and a half. So, but interest rates move up, well, you're going to create asset prices that were inflated by those lower interest rates. They become a lot more vulnerable on the other side. There's a real big secular issue here, though, Sean, in regard to what do people really do with their money? Because New Zealanders for a long time have been used to an environment where interest rates have moved down over 30 years. Interest rates move down while property prices move up. And property prices since 1991 have increased at an average rate of 7.3% per year in New Zealand. Income growth's been about 5%, so house prices in excess of income growth, well, one's rising faster than the other, so you're going to end up with an affordability crisis. So we're pushing the boundaries both in regard to valuations, but also, I think, where society's expectations are. But let's have a look at the economics. For the next 10 years, odds are the environment is going to be interest rates moving up. Now, interest rates move up is going to be a more challenging environment for house prices. It doesn't mean house prices move down over that 10-year period, but it means all odds are they're not going to be moving up at 7.3% per year. So what does that mean? If you're buying an investment property, you need to have a higher yield because maybe you're not going to get the same capital gain you've been used to over the past 10, 20 years.
Does it mean maybe that we might get away from what Brash always called this unhealthy obsession with home ownership or with property ownership? We might see people actually investing in entrepreneurial endeavours that grow our economy, in businesses that are going forward and expanding. And I'm not talking about my food bag.
No, and look, I'm with you there, Sean. I actually think we are at finally that inflection point where the penny now starts to drop, where New Zealanders realise we need to now be investing in real productive stuff. There is a whole lot of challenges to that. You go out there and talk to anybody at the moment and tell them the big trade for the next 20 to 30 years is to be investing in a business. And they'll look at you like a smoking pot. Why? You can't get labour, you can't get materials. You've got a government that's not exactly business friendly in regard to making that sort of trade. But what we know is that every sort of journey starts off small. Right?
Yeah.
It takes the brain sort of entering that story early on. But if you ever look at the market value of housing in New Zealand is about 7-8 times the market value of the New Zealand Stock Exchange. And the New Zealand Stock Exchange is 50% of GDP. If you look around the globe, most equity markets internationally are up around 100% of GDP. So we are seriously underdeveloped in New Zealand in regard to capital markets. So there's a lot of work that needs to be done here in regard to channeling money into the real productive sector. At the moment, banks like housing loans. Why? Because they're more capital effective from a bank's perspective. What does that mean? They need to hold less capital against a housing loan versus a business loan.
And they've only got 0.2% bad debt, as you just told us too.
But mind you, if you look at bank overall portfolios across the board, your non-performing loans across their entire book is around 0.5%.
Yeah.
So the banks in New Zealand have actually done a pretty good job in regard to managing those risks, but are we going to see those numbers move up in the next 12 to 18 months? Without a doubt. But they're coming off real lows.
I quite like the picture you paint that this could be an opportunity for us to fundamentally look at the way capital and investment capital moves in our economy and get away from, I don't know, the cul-de-sac of home ownership or residential property that we've been stuck in for so long, Cam. When we look at what a government or what this year's budget has done to move us down that path, has it done anything but, I don't know, sustain the sugar hit and just try and hold things off till the next election?
Right, so there was a good initiative within the budget, which was $100 million worth of, whether you call it seed capital or not. Everybody's got their own sort of names of it, but it was a little bit of money to basically help SMEs access credit, because we know SMEs have a lot of problems accessing credit. So there is a little bit of, there was a bit of money that was thrown at potentially what we can do on that. But if you look $100 million, businesses out there across New Zealand, excluding the farming sector, borrow about $120 billion across the banking sector. So 100 million is a bit of a tin pot number in the overall scheme of what the business sector is actually borrowing out there. I guess the flip side, the glass half empty to what we're seeing, by any benchmark, the 2022 was bigger than Ben Hur. It was a $40 billion spending package over 4 years. If you strip out COVID-related spending, your non-COVID spending over the coming 12 months is going to be up $15 billion. Now that's in a 12-month period. It's up 13.8%. If you look at spending over the past 5 years, 2018 to 2023, government spending has averaged 10.8% per year. Now, to be fair, we've had some pretty serious infrastructure, social deficits that we've needed to invest money on. Big issue there, Sean, are we getting results? We kind of don't know in regard to whether we're actually getting results, and the suspicion is we're not getting results. What we also know within the government projections is that they're spending like a carnivore at the moment in regard to eating habits, and what they're saying is that they're going to go on lentils for the next 4 years. Well, I've got a greater chance of being the next All Black coach. They're not going to go to a diet of lentils from the 2024, 2025, 2026 budget. And the problem with that is that the more the government spends, the more Adrian Orr, the Reserve Bank, is going to have an inflationary problem.
Yeah. Cam, we are heading into recession then, right?
Well, there's different connotations to recession. Right? Yeah, people tend to look at 2 quarters of negative growth.
Yeah.
Yeah, but if we get away with a scenario, so say the construction sector activity is down 10% from current levels, house prices maybe drop another 5%, the unemployment rate goes to 4 to 4.5%, and we get a couple of quarters of negative growth, that's what we call a soft landing. Yes, technically the numbers are negative, but you're coming off a real extreme period of strength. So we need to put a little bit of context. It's a little bit like the David Longy, we're stopping for a cup of tea.
Yeah.
Yeah, because the economy's just been doing too down. That's the fabled soft landing that the Reserve Bank is trying to engineer. The problem is soft landings are really hard to engineer because the economy twists and turns and can often turn on a dial. And what we've got out there at the moment is that we've got a real broad-based inflation story. And inflation is an evil that needs contained because it's a thief that steals people's money. And it's issue number one across households. The problem is that the recipe or the medicine for containing inflation is not that friendly. Yeah, you need to see some collateral damage across the economy where people are forced to rein in their spending. You need less housing market activity. A big part of inflation is construction costs, rents, housing-related inflation. How do you get housing, construction cost-related inflation down? Well, you got to bludgeon the property market. So it's not what you call a friendly solution, but these are things that we need to see on the ground to get inflation down, which we all know we're facing a cost of living crisis at the moment. So we've had too much of a good thing, and once again now we're into that paying the piper stage, and a soft landing is going to be hard to engineer.
How do the business sector feel about this? Confidence is a huge driver in any economy. What is the mood out there?
Well, there's sort of different levels of confidence, right? There's what's called headline confidence, which is business confidence. And if you look at business confidence, it's pretty lackluster. In fact, that's putting things politely. It's pretty awful in regard to businesses don't like the economic environment that we're in. But there does tend to be a political bias. So business confidence tends to be higher under a blue hui versus the red hui. Now, is business confidence a key lead indicator out there? The answer is no. It's politically biased. The economic indicator we look at a lot more is that when you ask firms, well, step away from the general environment, what are you thinking about your own firm? Are you investing? Are you making money? Are you hiring staff? What are you expecting about activity levels for your own business? Now, those numbers at the moment are still weak. They're lackluster, but they're not telling us the uniformly negative story that business confidence is. And those indicators tend to be a lot more real time, and they tend to give us a lot more information about what we're seeing on the ground. The indicator that has tailed off pretty sharply in the past couple of months is residential construction intentions.
Right.
The building consent cycle, the construction cycle is turning, and unfortunately, that is a necessary part of reining in inflation.
And you've got to say the builders have been doing it good during COVID. Everyone was staying at home and putting on the garage or doing up the spare room, weren't they?
Look, we've been into that too much of a good thing zone. We're scarcity, a sector doing really well creates an inflationary problem on the other side. So how do you fix scarcity? How do you fix demand or shortage of supply? Well, you curb the demand, and that's one of the side effects. We need to see fewer houses being built 12 months out to curb the demand for GIB, because that's how you get more contained prices.
Oh, it never works out perfectly. Look, Cameron, I know your clients are the big boys, some of the bigger investors and businesses in New Zealand. But for the person in the street, what's the best advice? And you're not a financial advisor and you will not be held liable for anything that goes wrong. What should the average Kiwi family be doing to ride this out?
Look, night follows day, day follows night. Right, the sun gets up in the morning. We go through these sort of cycles before. Now it's just that stage of the cycle. Just be a little bit more astute, a little bit more, pay a lot more attention to the I, dotting the I's and crossing the T's. It's a little bit more back to basics. When you're on the top side, when you're the rising part of the cycle, you can tend to be a little bit more euphoric.
Yeah.
Now, I tend to look at it, and it's apt for both households, and it's probably the wrong term to use, but businesses, but you put a little bit more of a risk management framework on. And just think about, well, things look okay at the moment. I think we're in reasonable shape, but you sort of don't know. So just be a little bit more careful in regard to what you're doing out there. There's an old adage for Hill Street Blues. Let's be careful out there. That's what applies when you get into the tail end of the economic cycle.
Yeah. Hey, Cam, always good, fascinating speaking to you and getting your views on what are matters that affect all of us and will affect all of us, particularly in the months to come. Thanks so much for taking the time to join us on the platform today, my friend.
No, all the best. A pleasure.
Cheers. Cameron Bagrie there. He is the Managing Director and Chief Economist at Bagrie Economics.